Welcome to Smart Wealth with Joshua.
This is your daily stock analysis and catalyst talk. We are here to cut through the noise and get straight to the numbers that matter for your portfolio. Today, we're looking at Crocs.
That's right, the foam clog company that has somehow become a real battleground stock. If you find our talks useful, please consider subscribing, liking, and commenting underneath. It really helps us out.
Yeah, it really does. And we have a lot to get through today. We're breaking down the Q4 2025 earnings report and, maybe more importantly, the outlook for fiscal year 2026. And, the market reaction to this report was, well, explosive.
Explosive is the word. I mean, we saw the stock pop 21% immediately after the earnings dropped.
Yeah.
That is a massive, massive move.
For a footwear company.
Exactly. You see that in tech or biotech maybe. But seeing a shoe company jump a fifth of its value in one session is just, it's wild.
It is, and what makes it so fascinating, and this is really where the smart wealth angle comes in, is when you actually look at the headline numbers that triggered this jump. If you just glanced at them without any of the context, you'd be scratching your head asking, why is everyone celebrating?
Okay, let's unpack that, because there is a real paradox here.
Yeah.
So revenue for the quarter, it came in at $958 million. But if you look at that year over year, it's actually down 3.2%.
Right, down. And then you look at the bottom line, earnings per share, or EPS, that came in at $2.29, also down about 9.1% from the same time last year.
So let me just get this straight for everyone listening. The business is shrinking, revenue is down, earnings are down, and the stock jumps 21%. Why does a company get rewarded for shrinking?
It is the classic game of expectations versus reality. Look, the market was bracing for a complete disaster here.
Okay.
You have to remember the context, right? The consumer discretionary sector has been weak. People are worried about spending, so investors were expecting Crocs to take a serious hit.
So the whisper numbers were probably even lower than the official street estimates.
Exactly. The consensus estimate for revenue was only, $916.2 million? They delivered $958 million, so they beat that handily.
And what about EPS?
Same story. The street was expecting $1.92. They came in at $2.29. That's a huge beat.
So it's less about, hey, we're growing like a weed, and more about, we have incredible control over our business.
Precisely. It's all about operational discipline. They managed to squeeze out a beat despite all the headwinds. It shows investors that management knows exactly what they're doing.
It feels like a relief rally then. But, looking deeper, there seems to be something structural happening under the hood. I was looking at where the sales are coming from, and there's a huge divergence.
This is the most critical part of the story for any long-term investor. It's this massive shift in their channel strategy. You've got direct-to-consumer, DTC, and you've got wholesale.
And they're moving in completely opposite directions. DTC was up 4.7%.
Right.
But wholesale, that was down a pretty painful 14.5%.
And that's intentional. That's a strategic choice to prioritize the health of the brand. DTC now makes up more than 50% of their entire enterprise revenue. That's a huge tipping point.
So why is that 50% number so important? Why should a listener care if they buy their Crocs from the website or from a big box store?
It's all about building a moat. When you sell direct-to-consumer, you own the customer, you own the data, you control the pricing, and you protect your margins.
Ah, I see.
Wholesale is just so volatile. Retailers can cancel orders, demand discounts, and, delete your brand by piling shoes in a clearance bin. By shifting to DTC, Crocs is basically building a fortress.
So they're taking a short-term hit in sales volume to build a healthier business for the long term. They're cleaning up the channel.
That's the perfect way to put it. They're sacrificing low-quality revenue for high-quality control. And, it's working. If you look at where the growth is, it proves the brand is still hot.
The international numbers.
The international numbers. Look at China.
Yeah, I saw that. China grew 30%.
30% in China is huge. I mean, we've seen so many Western brands just get crushed in China recently. This proves Crocs isn't just a U.S. fad. It travels. It resonates globally.
And it's not just the clogs anymore either, right? I mean, clogs are still the bread and butter, 74% of the mix, I think.
Still the king, yeah. But sandals are creeping up. They're at about 13% of the mix now and growing. And that diversification is key. It proves they can stretch the brand.
And they keep hitting these cultural moments with partnerships like the Lego one.
Oh, the Lego collab was brilliant. It just keeps them relevant.
It really does. But okay, let's pivot to the money. This is smart wealth, and we need to know how this company actually builds wealth for its shareholders.
Agreed. Cool shoes are great, but they can still be a terrible investment.
And this is where the story gets really compelling for me. This isn't just a shoe company, it's a capital allocation machine. Let's talk free cash flow.
This is the metric that matters most. For
Yeah.
the full year 2025, they generated $659 million in free cash flow. That is a massive amount of cash.
And just so everyone's clear, that's the cash left over after they pay for everything. It's the cash that belongs to the owners, the shareholders.
Right. And the real question is, what did they do with it? They didn't just let it sit there. They went on a shopping spree for their own stock.
An aggressive one.
Yeah.
They repurchased 6.5 million shares. That's $577 million spent on buybacks.
Just think about that number. Over $500 million. When management spends that kind of money buying back their own stock, they are screaming that they think it is undervalued.
And they did this while also paying down debt. I saw they paid down $128 million in debt.
Yep. So it's not like they're just leveraging up to pump the stock. Their net leverage is sitting at the low end of their target range, a very healthy balance sheet.
So let's pause. We have revenue down, earnings down, but because they're buying back so much stock, the value of your remaining shares is actually going up.
That is the magic of what some people call share cannibalization. They're shrinking the denominator. So even if the total profit shrinks a little, the slice of the pie that you own as a shareholder gets bigger.
It's a very shareholder-friendly way to manage a business. It's the difference between a growth stock and a shareholder yield stock.
Exactly. But look, it's not all good news. We have to talk about the elephant in the room.
The problem child. Haydude.
Yeah. That acquisition, it has been rough.
Rough is a kind word for it. They spent billions on this brand, and it's been a drag ever since.
There's no sugarcoating it. For fiscal year 2025, HYDDE revenue was down 14%.
And the guidance isn't exactly promising a quick turnaround. They're guiding for it to be down another 7 to 9% in 2026.
It's that same shrink-to-grow strategy. They're trying to clean up the wholesale channel there too, but it hurts in the short term.
On top of that, you have macro headwinds. We have to talk about tariffs. That's a huge issue for any footwear company.
It is, and Crocs is definitely exposed. There's a potential $80 million drag from tariffs coming.
80 million, that's not pocket change.
No, that's a 100 to 200 basis point hit to their margins. That's real money.
So let me play devil's advocate. You have a shrinking second brand. You've got this big potential tariff bill. Why isn't the stock tanking?
Because management is ahead of it. They've already identified $100 million in cost savings.
So the savings basically cancel out the tariff hit.
Almost dollar for dollar. It neutralizes that risk. It takes one of the big bear case arguments right off the table. And with AYDIE, management is being very clear about the timeline. They expect it to return to growth in the second half of 2026.
So they're asking investors for just a little more patience.
It's a show-me story for the second half of the year, but not everyone is buying it. I mean, there's some serious institutional bearishness out there.
Oh, absolutely. Blue Shift dumped, what, 34,000 shares? It's almost $3 million worth of stock.
And then you have Goldman Sachs. They're still holding a sell rating with an $81 price target. That's way below where the stock is trading now.
So Goldman thinks the stock is going to crash from here.
They're clearly skeptical. But that brings us to the forward guidance, because this is what really lit the fuse on that 21% rally.
It wasn't just what they did in Q4, it's what they said they're going to do in 2026.
This was the real shocker. The street was expecting EPS of around $12.10 for the full year. Crocs came out and guided for $12.88 to $13.35.
Wow. That's a huge beat on guidance. They're telling analysts, your models are just plain wrong. You're way too pessimistic.
And that forces analysts to scramble and upgrade. And we saw that immediately. Stifel raised their target to $99.
Barclays went even higher, to $109.
Right. It completely changes the narrative. Suddenly, the stock looks cheap again relative to those future earnings.
If they hit $13 in earnings, the PE ratio is in the single digits. That's very attractive.
And technically, the chart looks like a breakout. This stock has been dead money for the last year, just lagging the S&P 500. This pop pushed it through some key resistance.
So the sentiment has totally shifted.
I think so. It went from can they survive to how much cash can they print?
Okay, let's wrap this up on the summary. We like to give a score on the show. Where are you landing on this one?
I'm giving this a bullish score of 8 out of 10.
8 out of 10. That's high confidence. What's the core thesis in a nutshell?
3 things: operational discipline, massive buybacks, and conservative guidance they can beat. They're managing for profit and cash flow, not just empty revenue.
And the risks.
Look, the AYDDD risk is known. It's priced in. If it stabilizes, that's pure upside. The tariff risk seems hedged. The downside feels protected.
All right, so here's my final thought for everyone listening. We talked about HYDE being a drag. The market is basically assigning it zero value right now.
Or even negative value, yeah.
But management promised to fix by late 2026. If they actually pull that off, if HYDE stops shrinking and starts growing again, is there a massive second leg of growth here that nobody's pricing in?
That is the million-dollar question. If they fix the problem child, this stock isn't just a value play anymore. It becomes a growth story again.
And growth stocks trade at much higher multiples than where Crocs is today.
So you're basically getting a free call option on that turnaround.
Something to watch very closely. Well, that's all the time we have. Thanks for listening to Smart Wealth with Joshua.
We'll catch you on the next one.